Now we're going to pivot over into the physical market, but we really want to start with China because China is the one where a lot of individuals, or at least a lot of people in the market, were saying that they were going to be the big buyers. You're going to get this massive bump in activity. And we've been saying it's just we're not going to get the bump that was expected. Instead, it's going to fall a bit flat after we had that nice little increase in some of that activity, but things will slow down. And there's a lot of pressure on different economic fronts, from the consumer side to exports to industrial activity, and you just don't have the lending capacity that you had in the past, or at least the desire for that borrowing as we had in the past. So here, when you look at China crude versus refinery runs, this is something that was done by Reuters, and I think it's really good. And if you're not following Clyde Russell on Twitter, you're missing out. He puts together some great content and some of these great charts, specifically on the physical market. So one of the things here is it's good to look at where refiners are active and the total crude that's coming in. And you can see that for the last year or so, they've been accumulating more and more product into storage. And that's not crazy. I mean, that's something where they had pulled down from storage, so they're going to refill. The question is, when does that stop? And one of the things that we've been talking about is they're bridging some of this gap because they're taking advantage of this cheaper Russian crude and these sizable increases of Iranian crude flowing into the market. So some people have asked me, I was talking to a client the other day, why do you think Iranian crude is increasing so much? Because we've been talking about this for a couple of months before it showed up in some of the data, which we'll show in a minute. It's just because the U.S., let's be fair. We have satellites. You can track a lot of boats very closely. I mean, they could see the color of your eye from through a glass window if they wanted to. So to track the boats is possible. The question is, how strict are they going to be on movements, because they still need inflation to come down, and there's a big issue on light, sweet versus sour. So right now there is more than enough sweet in the market. There's not as much sour in the market as there was. There's a lot of light, not as much medium and heavy. So Iran produces some of those great crudes that are needed in India, in China. So I don't want to say quietly, but instead we just won't say much. Now, typically, Saudi would be the one to push back on us being quiet about it. But since they did a deal with Saudi Arabia to have some sort of peace agreement, or at least an armistice in Yemen, that has slowed things down. Iran has been fairly quiet in Iraq. You haven't seen a lot of support from them going into the Houthis, the Hezbollah. Not that they've pulled out support, but you're not seeing this huge cash inflow, which typically turns into some sort of aggressive action, whether it's in Syria, whether it's in Yemen, whether it's in Lebanon, in different ways. Instead, you've seen this quieting period, and they're trying to push this crude into the market, which is why there hasn't been too much to be said. Do we think this is gonna turn around and become a new bank account to sponsor terrorism? I don't think so, just because they have a lot of internal issues right now, both politically speaking, geopolitically speaking. So it's unlikely that you see much, but that's putting more crude into the market, and that crude is again pulling some of that in, and China is obviously the key buyer, as well as Iran. And when you look at some of the quotes from Clyde, flows into stockpiles are the largely ignored but potentially vital cog in China's crude market. May was significant, with 1.77 million barrels a day added into inventories, the most almost in 3 years. Inventory builds exceed import gains so far in 23, which is what we were talking about, taking advantage of some of this. Saudi, Kuwait, UAE, Iraq, and Iran are all increasing their production capacity in the coming years. Brazil, Norway, and Venezuela are doing the same. Venezuela is obviously going to take some issues, but Brazil, we've talked about it. UAE has already seen their quota increase, but they're not the only ones. And that's why, yes, is there some areas where production is falling? Absolutely. But there's also other areas that are increasing. And that's what we've been trying to hone in on, especially Iraq and the UAE and Saudi. The final factor in China's oil market is exports of refined fuels, which were up a strong 45.4% in the first 5 months of the year. Exports of products were 26.79 million metric tons in January through May, up from 18.45 million the same period last year. But remember, last year was super low. So you're coming off of a low base, which we'll talk about in a minute. So but again, that's what he's highlighting. What we've been discussing is you can't just look at crude. You have to balance it between crude as well as exports. So crude imports, if they explode, you might be thinking this is great, but how much is staying in products? How much is staying in storage? How much is being exported as products? And that's why you get this balancing act, and why we think they're not going to be the saving grace that people are expecting, because yes, they're importing more, but they're also exporting more product, which is going to push down crack spreads and hurt other refiners that aren't buying Iranian crude, Russian crude, and obviously getting undercut in terms of margins. This is one from Kepler. When you look at China's onshore crude storage is increasing. You can see it's now approaching 2020 levels, and crude oil inventories in China is now at the levels that we've seen, is the highest that they've been in 2023. And given the purchases we've seen so far, which we'll show in a minute, they will likely take out those 2020 highs because they're still buying at elevated levels, with refiners still not really active as we expected them to be, which just means that more crude is going into storage. Now, obviously, they'll still say that they're not importing Iranian crude. For those that have been following us, whether it's on YouTube, whether it's just knowing me in the past, whether it's reading our insights before we started doing YouTube, it's Malaysian crude. They always flag it as Malaysian. Some of it is flagged as Iraq. I'm not saying it isn't, but a lot of it is Malaysian. And this is a fun one where the China claims it imported 1.4 million barrels a day of Malaysian oil last month, which is a fresh record high and almost triple the real output of Malaysia. I can assure you they do not have that amount of storage. They do not have that amount of production. Again, it's Iranian crude. So now when we start looking at inventory buildup, so OECD crude and liquid fuel stockpiles rose toward their 5-year average, which again, it's just going to weigh on oil prices, but not weigh on oil prices as like drag them down because, oh my God, we're at the 5-year average, therefore crude needs to be 40. It's just, why are we going to go higher? There's nothing pointing to, from an economic perspective, from a demand perspective, from a demand perspective, that we should go higher. We shouldn't really go that much lower because of the supply floor that we've talked about. But again, there's nothing driving this that's showing that we need to go, and that's why we continue to see this range. Total month oil supply, when you look at May, now that the full numbers are in, total fell by 827,000 barrels. Iraq, again, continued to be under pressure. We have not heard anything from the CN pipeline. That's something that we'll continue to look out for. Angola, small increases. Nigeria, small increases. As we talked about, Saudi had the drop. UAE, fairly stable at this point. But realistically, Libya is going to continue to be over 1.1 million barrels a day. Russia is going to be about 9.5. So really not too much surprise. Iran is likely going to creep a bit higher. They can get back to where they were, but to get above that is going to take a significant amount of investment. Now, it's investment worth making because Iran is one of the few places where it's still just about as simple as a straw into the ground. Obviously, oversimplifying, but still, Iran still has a lot of low-hanging fruit potential. Libya, similar. Venezuela, similar. It all comes down to politics. But that's why, realistically, if Iran ever found some sort of regime shift, I would be one of the first people jumping in there to make an investment and grow that business. So now when we look at the Middle East, floating storage continues to rise. We talked last week how the Red Sea had a lot of crude that was on Saudi cargoes in the Red Sea. A lot of that was going into pipelines. We believe that is going into some more storage. But you could see this is going to be the one to watch. This is going to be the crux of the problem of where is production. Where is production in general, and then where are floating storage? Is floating storage building? If it is, which is likely, it means that, again, we're trending in the wrong direction, and this is going to keep Saudi awake at night when you look at some of the different flows as UAE pushes out a bit more under the Murbain contract, and you see some of their crude remaining stuck. U.S. exports, again, on the 4-week rolling average, staying high. We don't see it changing from here, even though there's been some pressure on margin just because of the increase in shipping prices. We still see some of that crude being pushed into the market. Similar to what we talked about in the U.S. is happening in Singapore, where gas oil prices cracks have come down. As we said, a bit of a spike, and then will fade, so coming closer to $13, $15. We don't see it getting back to 10 yet, but again, you'll see that drift a bit lower. But at these prices, you're still going to see operations running, and you're going to still see activity. Now, when we look at the Dubai Brent swap, again, you're seeing some of these pushing lower. It's what we've been saying. We're going to stay at these levels. You're going to see some of these pressure points in general in terms of where they are. Global crude oil on the water, it's at a seasonally adjusted all-time high. You have, again, the highest level in 2023 as you continue to see crude getting pushed into the market from Russia. You have more refined product being exported from the Middle East, i.e. Kuwait. And then that's, again, just you're seeing a lot of crude sitting out there. And that's why prices are also going up, because a lot of these ships are in transit, are in floating storage. And this is the hardest one to track, which is why it's so important to look at how much crude is out there, because you could also slow steam it. You could show that, land storage isn't too high. It's like, well, if I'm telling 5 of my 10 cargoes, go the long way, don't go through the canal, take the scenic route, don't run at full steam, run at 75% of normal. And they're trying to time this so they don't have this buildup. But again, this is going to leave a lot of that crude on the water. Crude oil in transit is back to 2023 highs, and at the highs that we saw in 2020. Again, there's a significant amount out there, and you're going to continue to see that get pulled through. Now, when you look at global crude oil in floating storage, we are back to seasonally adjusted highs. We're below where we were in 2020, obviously, but this is a bit shocking to us because we thought we were going to be something closer to 2022 levels. But this is the Middle East. This is Saudi making that decision of raising OSPs. You're just seeing people essentially avoid some of those cargoes, putting them in storage. You're starting to see a little bit of a shift higher in some of the other floating storage regions. And it's going to be elevated. And this is going to be an important one to watch when you look at crude pricing. And this is why we're saying that there's more crude out there than what is being talked about, which is why Saudi is cutting, because they are trying to put that floor in. So when you look at it, if OPEC Plus was operating at quota levels, crude would be $10 lower, but they're not. So you have to account for that. So, and that's why we see that trading range, because that's going to keep them to the downside. Now, it also doesn't mean that all crude is created equal, because the mediums and the heavies and even the sour side is trading at a premium versus where we are on light sweet. And it's because of that disconnect between how much light sweet is available, how much medium to heavier sours is available, and that is creating some of that disconnect. Asian floating storage had a small decline. We do see this popping back above 2022 levels just as some of these cargoes start to show up. And then it's important to look at crude imports. So we did get a little bit of a bump in Chinese crude imports. But typically, normally speaking, when you start from the end of June through essentially all of July, you get a sizable drop down in imports. And again, that's likely not going to change directionally speaking. The rate of change is going to be much shallower than normal because they're pulling in an excessive amount of Russian, an excessive amount of Iranian or Malaysian crude, and that's going to keep them elevated. But again, it's still going to trend lower, which is what Saudi is aware of, which is why typically in July they're cutting some of their crude, because you're going to see less demand from China. You're going to see, less demand in general, given they want to pull that crude off the water. The whole concept is to try to get that off the water, balance the market a bit. What we think is it's not going to take just July. If they really want to do that, they're going to have to go into August as well. And are they willing to keep the same million barrels, or will they reduce it? Because typically you normally get China buying a bit more. You get more buying that happens in August that continues into September, which they may want to try to marry that in terms of, okay, well, we'll bring some back because we'll bring it back because we want to keep it at 75. We've lost money. Now we want to try to make some of that money back on a volumetric basis. When we look at exports, when we look at diesel, you can see that diesel exports were still elevated. But again, put it into context. Seasonally adjusted speaking, they still exported at a lower number. And a lot of that is because of the, that lower base that we talked about from 2022. But we do see some of this drifting higher, especially because we don't have the industrial and manufacturing demand that I think was expected. Now, when you look at gasoline, on the other hand, had a big increase. And a lot of this is driven based on that misunderstanding or this view that the Chinese were going to continue to drive at this exponential rate. Well, there's a lot of gasoline sitting in there. So this is the big driver, which is why we continue to talk about the gasoline markets. We're going to get builds in light distillate in Singapore. We're going to get more of it in Fujairah. That's going to flow back to the Atlantic Basin. You already have Europe at multi-year highs. And again, a lot of that is going to get pulled into the U.S. market, i.e. the East Coast. Now, the congestion index started to increase in China. For those that don't that aren't aware, this is the Dragon Boat Festival. It kicked off today, so typically, which is why you get that nice little spike. It's just going to be seasonal. It'll come back down, and it'll stay, again, very similar to where we were in 2022. We don't see this big surge back up, but that is where we're getting a little bit of that bump, and it will fade, and that's where we continue to see things trending here. From a refinery utilization rate, still no wake-up call. It's still at 61.9% utilization rate. And if you look at 2022, you normally, if you look at week 21, in 22, they were at 60.6% utilization rate. And by this point, they were at 65.6. They normally start to see an increase. And this is a lot of kind of marrying of, well, how much storage do we have available? What does demand look like? And I think, and obviously now we're coming into the holiday, we will start to see this increase. But again, it's at a much more muted basis because on a 5-year average, they should see it be at 67%. They're at 61.9. So again, it gives you an idea of some of the problems that remain on the demand front in the Chinese markets. West Africa floating storage continued to decline a bit. Obviously, the rate of change has slowed. We've started to see some price reductions. Again, not huge price reductions, but that just means that we're probably going to start to see this flat line. We likely won't see an increase in floating storage, but again, it's just a bit of a flat line, a slight probably movement higher. When you look at crude oil, when you look at exports from the U.S., gasoline dipped 98,000 barrels, just a small dip, still above the 5-year, but that should trend a bit lower. Distillate was down 66,000 barrels a day, 150,000 below the 5-year. That is going to remain below the 5 years we've talked about. Propylene, dipped 257,000 barrels a day, still well above the 5-year average. You're going to get some of that ebb and flow. And then crude oil exports increased to, here it's at 4.5 million. But as we've been saying, it's going to be at an average of about 4-week rolling average of about 3.8 million barrels a day. There's still demand for it. You're still going to see those flows going out. And then when we start looking at underlying movements, so gasoline, as we said, was a bit too high. It was going to come back into that top of the cloud, likely trend a bit lower. And then when you look at distillate, as we were saying, kind of hang in at the low end of that cloud, just as the distillate side, we did get some decent draws from Europe that could pull in some additional distillate from the U.S. It'll likely be coming from the Middle East, but again, it could probably be a balancing act. So we should get a little bit of support in the distillate fuel export market. I wouldn't say above the 5-year, but again, that's going to be an interesting one to watch. Crude oil, just staying at the highs, nothing crazy there. Propylene coming back down, but as you can see, averaging still very strong. We don't see that adjusting as well. Ethane, again, it's a bit lumpy. still staying above the 5-year average. It's still going to stay above the highs. Now, when we pivot to Fujairah, stocks were reported at 21.838 million, a rise of 2.272 million. But remember, we said that this was going to happen, that things got a bit lower and you were going to get a sizable spike. And here we are. Light distillates increased 802,000 barrels in total. East of Suez gasoline complex softened in early trading as Malaysia gasoline demand was lackluster. Despite the upcoming Eid festivals, Malaysia is seeing some slight increases. But again, when you look at the underlying shifts, the rise, the question is going to be what is normal. And as we've been saying, there's a Eid holiday and the rise is not as high as typical seasonal spikes. So again, that's that pressure that we're talking about on the consumer. That is, it's spiking, it's going up. It's just not going up to the level that was expected. And that's what we continue to talk about, some of those failings that we continue to see. And the short-term tightness in India was brought about by the temporary closure of the Sikka port, which is expected to ease moving forward. So again, we don't see this is a long way of saying we continue to see builds in light distillate. Middle distillate rose 1.028 million. The backwardation east of Suez gas oil market eased slightly, but stable demand. And again, that lean supply continues to kind of bolster sentiment. Demand for the ultra low sulfur grades has remained largely stable in Asia. That's where we should have seen some of those reductions, but we did get some issues in Vietnam with one of their facilities. It was scheduled to shut down for 55 days for planned maintenance. From August 25th on, there were some delays in getting some of that equipment. So again, there's some of those different back and forths. That's where we're going to continue to see some of those pressure points in general. Again, middle distillate's going to remain at the lower end. That should improve over the near term. Heavy resid rose 442,000 barrels in total, coming right below 10 at 9.8. Spot trading activity for bunker hubs were moderate, but again, still remaining a bit weak as that demand continues to be underwhelming. When you look at Brent, it's now in contango. That's something that will likely start to remain in contango, just given some of the issues, or I should say some of the cost of shipping and that slowdown when we look at the demand side. Now, when we look at the physical market, the physical market, Angola took down some of their expectations or some of their levels for August. This could remain a bit elevated because you can see July is still higher. You could get some of that, push from July into August. Norway, again, continuing to ramp up as we've been talking about. Nigeria is going to be fairly stable. Russia is at a very high level at just over 4.8 million barrels a day. Again, they're trying to maintain that. Libya just announced about 1.06 again for not only June, but also July, very stable in general. So there's not too much change. Obviously, Russia's the big one where you're continuing to see flows. When we look at Angola in general, you've had some slightly stronger numbers for the same grade coming through. At Eni that sold 950,000 barrels of Angola's Camadina at positive plus 60 cents to 70 cents above dated Brent. It was previously at 30 cents. So again, a little bit of strength. Vital offered 950,000 barrels of Nigeria's Gravos at $4.25 plus dated Brent, but that's much less than what they were. So they initially were at $4.60, and then they dropped it 5 cents to $4.55, and now they dropped it 30 cents to $4.25. So you're seeing that they're starting to get a little bit more aggressive on some of those drops, which is going to be an interesting one to watch. Asia's demand for heavy Angolan crudes and the Congo's crude is still healthy, but rising freight costs are limiting some of the upside. But remember, they have to replace some of those flows, which is why you're seeing some of that elevated numbers. When you look at the Diango has traded below dated Brent by $2 for July. Similar to deals for June loading, but again, it's been trading about $1.60 to $2.20. So again, not a huge amount of strength, but not a huge amount of weakness either. It's kind of finding its zone right now, which is why we think that there's a little bit of a balance, especially if you're talking about the heavier crudes versus the lighter crudes, because again, you're getting some of that demand. Chevron has been named the operator of the zone for between Angola and Congo. So we will start to see that starting back up. And then in general, that's kind of what we see in the physical, like the actual physical market at the moment, not too much one way or the other. What's coming into Europe, you're continuing to see Genscape reporting builds, which again, it's just you're slowing demand from the refining side. We did get some builds. We will get some of that increase, and some of those runs, again, will run a little bit higher, which will draw down some of that crude in Europe. But when you look at the European side, you can see that there's you typically start to see some of those draws as we get into July. When we look at gasoline had a build of 42. Gasoil had a sizable drop of 213. But fuel oil had a big build of 142. So this is going to be an interesting backdrop because how much is going to be one versus the other? Are you going to get some sizable builds in one, and then because you can't sell it, you're going to recrack it? And that's going to be the balancing act and the blending that could happen between fuel oil, gas oil into the crude pool. But realistically, way more along the lines on the fuel oil side getting blended into crude. Gasoline, again, the only time it was higher was 2020. You can see that they're still running at a very high level, which will support those flows, as we've been saying, from Europe into the U.S. markets. On a fuel oil side, massive spike. We're at the highest levels we've been at since 2023. The highest levels of 2023. We're approaching 2021 levels, and again 2020 levels, which is where we normally start to see this get blended back into the crude pool for cracking. So that's also going to slow down some of the demand for crude, and it's going to leave some of that in storage, which will put some of that weight again in the European markets. In Singapore, we had a nice draw on the total fuel stockpiles. When you look at what drove that, we had some draws from light distillate, slightly below where we were in 22 and 2020. We do see that reversing a bit higher, not really breaking to new highs, just kind of hugging where we were in 22 and in 2020. And then on the light distillate side, nice drawdown, making seasonally adjusted new lows. We do see that bouncing back up, but staying fairly tight because the market, it's still supportive, and that's why we saw some of those increases in crack spreads. But as refiners increase runs and that industrial demand continues to be sluggish, we do expect to see some builds coming through in that area. Resid heavy fuel oil again is going to bounce back and forth. That's going to we do see this bouncing a little bit higher. When you look at North Sea, floating storage is fairly flat. We don't see too much of an adjustment at this point. If anything, it might trend a little bit higher, just given some of the increase in productions. And then when you look at Europe, again, it's the balancing act. There's a lot of crude and land. We'll likely see some builds on the floating storage side, and then that will get worked through over time. So that's what we have for you today. If you have any questions, we'd love to hear from you. And thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.